All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Monday, everybody. Hope you all had a wonderful weekend. Today's Monday, August 17th, 2026. Our top story this morning, man, there's been a series of articles about AI bubble debt this morning, and I am just overcome by the collective stupidity of it all, and at the same time, just marveling in my abject failure to convince everybody to stop doing this for 3 years now. And look, I tried to run the flag up the pole, like danger here, guys, problem, like red flags over here, SOS, all the way back in the summer of 2023. And well, to say those warnings went unheeded would be to put it mildly. Full speed ahead in the AI spending. And now the AI bubble has gotten so big, I don't even think we can call it a bubble anymore. It's the AI bender has now gotten so big that it is competing with the United States government for debt issuance. I shit you not. They're now borrowing so much money that they're on the same level as Uncle Sam, who is also borrowing at a record level. That's important to note. It's not like the government is like, well, AI is borrowing all this money, I guess we better slow down. No, they're not. They're all just borrowing all the money in the world. Investment grade bond issuance is on pace this year to exceed the investment grade bond issuance that was issued in 2020. Keep in mind, in 2020, interest rates were nothing point nothing. The Fed lowered them all the way down to zero. They're borrowing at the same rate they borrowed when it was free, even though interest rates are spectacularly higher now than they were back then. On pace to exceed $1.5 trillion in investment grade bonds. I'm sorry, no, that's just what's been issued year to date, not on pace to exceed. That's what they've already issued. It's August. Guys, there's several months left. Now, some investors are actually selling U.S. Treasury bonds in order to buy up some of this debt because they're paying a premium for it. The AI companies are having to pay even more interest than Uncle Sam is. And some bond funds are now increasing their exposure to this corporate investment grade bond issuance. And again, this article in Bloomberg is only talking about the investment grade stuff. There's plenty of junk garbage debt out there that's also being issued in order to pay for the AI bubble. And it's got, we got to talk about concentration risk here because we're already the average person. And it's so important for people to understand this, that everybody is invested in this stuff, whether they realize it or not. If you have any kind of a retirement plan, you are into this stuff. All right. Now, the S&P 500, the top 5 companies alone in the S&P 500 represent 30% of the index. All right. So if you did what your guy at Vanguard or your guy at Fidelity or your guy at BlackRock told you, and you bought a well-diversified portfolio of index funds, understand 30% of the money in stocks is in the same 5 companies. And they're all AI companies. But he might say, but you know what? We want to spread out your risk. We want to put you in a nice diversified 60-40 portfolio where you got 60% stocks and 40% bonds. Oh, well, don't worry. This guy who, for whatever reason, I started talking with this weird accent there. But don't worry. The bonds that he's now putting you into in your 40 of your 60-40 portfolio, to diversify, well, those bonds are issued by the same effing companies that your stocks are now concentrated in. Yeah, both sides of your diversified portfolio are invested in the stocks and the bonds of the same 5 companies that have all made one giant debt-fueled bet on an unproven technology where 3.5, 4 years into this bubble has still produced a combined $0 and 0 cents of profit collectively. Holy shit, what are we doing? What are we doing here? And this article in the Wall Street Journal is phenomenal. The visuals in here, AI spending is $3 trillion higher than it seems. Because that number that I gave you, that $1.5 trillion in investment grade bonds that's been issued, that's just the on balance sheet stuff. There's way more that they're not showing us. Little footnotes in their earnings. Oh, we have unfunded liabilities and we have leases that haven't begun yet. Those exceed $3 trillion, according to the Wall Street Journal. Oh, and that's only 4 companies. That's just Amazon, Meta, Microsoft, and Google. Those numbers, that $3 trillion figure, does not include Oracle, one of the biggest spenders in the space, and it doesn't include any of the neoclouds. Just those 4 companies. What are we doing? Now, think about this, guys. We're talking about $3 trillion of spending commitments right now. And also keep in mind that this bubble is predicated on growth, on these numbers, not only how big they are, but the rate with which they are increasing. So if we're currently at $3 trillion of these unfunded, whatever you want to call these massive liabilities that these big tech companies have taken on, where are we going to be in another 3 years? Because remember, not only do we need to maintain our current trajectory, we need to accelerate it because that future growth is already priced in. The amount of money that is required to maintain this bubble for a couple more years is in the tens of trillions now. In other words, more money than exists on the face of the earth. Where the hell is it going to come from? They're already competing with Uncle Sam. They're already competing with freaking Scott Bessent, with the U.S. Treasury for debt. Now, I get this comment a lot. So many people are out there saying it's now too big. They won't let it fail. Whoever they are, these omnipotent, powerful people elsewhere with no faces or names that somehow are able to make math and physics not matter. I don't know who they are, but man, I'd love to meet they. They won't let it happen. That's what I keep hearing. There's going to be a bailout. And you're exactly right. There may be a bailout. There very well may be. The problem is now so big, they can't afford to let it fail. But here's the thing. They can't possibly stop it from failing. They can only delay the failure. And that kind of money, the amount of money that will be required to keep this bubble inflating, can only be provided by the Federal Reserve. And the Federal Reserve is not going to print trillions of dollars without a crisis, which means the crisis gets here first. So if you're long these companies right now, which everybody is, it's important to note that everybody is invested in this stuff, whether they realize it or not. You are betting that this will continue and the Federal Reserve will monetize this debt without a massive liquidity explosion. I don't think that's going to happen. I think the Fed probably will at some point try to monetize all this garbage, but not until after it has started to fail at such a rate that it causes a panic and a liquidity crisis. Usually the crisis comes first. I could be wrong about that, but what are we doing? The numbers are in the trillions now. Just stop it, guys. Stop. Just cut the damn CapEx. I say this all the time. All right, going on elsewhere. We've had oil is moving around this morning. We've had a series of unfortunate geopolitical events and quotes in the oil market this morning. We'll talk about that silliness. Nvidia also, speaking of the numbers are now too big, very quiet Friday news dump happened. After the close on Friday, Nvidia downsizes their $250 billion backstop for an OpenAI data center in Ohio. It's now $120 billion. They're going to backstop $120 billion, which still, holy shit, that's a lot of money. But it's half as much as they told us before that they're going to do. And the reason they're doing it is because their investors are worried about NVIDIA's exposure to OpenAI. Oh, you think? You think? And by the way, they're slowly walking this back. And again, they're telling people on Friday after everybody started their weekends and they can't dump the stock and panic and they'll all forget by Monday morning, but nobody remembers. Yeah, they're saying we're only going to guarantee half of it for now. We'll revisit the other half later, which means they're keeping the rest of that $250 billion on the table. They're just not going to commit to it right now. Also going on this morning, across the pond, we got some lousy economic data out of China. Industrial production expanded slower. Retail sales expanded slower than expected. By the way, the fact that either of those expanded, I don't quite buy that, to be honest with you, not after looking at that oil import data. But fixed investments slowed a dramatic 6.7%. The jobless rate rose, or the urban jobless rate rose. China's economic growth is slowing, according to this government data, which big asterisk and big grain of salt, because it's Chinese government data, highly prone to manipulation. But it shows China's economy is slowing. And again, when you look at that that oil import data, that the reason oil isn't 3 digits right now is because the Chinese are importing millions of barrels a day less. Maybe that's got something to do with China's economy slowing, and they're just taking advantage of this crisis to kind of sneak that in there. And the reason, of course, China's economy would be slowing is the Chinese real estate collapse that has been ongoing for multiple years now. Home prices in China fell faster in July than they did in June. That is now 3 consecutive years of home prices falling in China. There was a very brief period of home price increases at the beginning of 2023 with the big COVID reopening. Go back 2 years before that, home prices were falling also. The real estate collapse in China still hasn't found a bottom. Here we are in 2026. Japan also has some lousy GDP data. The Japanese economy grew at just 1.1% in the second quarter. That's versus expectations of 2.0%. A big miss on Japanese GDP. And really, the only reason Japan's GDP is even growing is because their net exports got much bigger. And that was created by electric vehicles exports, chip exports, again, the AI bubble keeping Japan afloat, and also far less oil imports in the second quarter because of what happened with the Strait of Hormuz. So that probably won't be like that for long. Japan's borrowing costs are rising, and that increase is accelerating. The fiscal mess in Japan will have to be addressed, along with the obscenity of the AI bender, the AI bubble, and Uncle Sam spending here in the United States, but it ain't going to happen today. We got another Wildberries distribution center was blown up in Moscow yesterday. This has been going on for a couple of months. The Ukrainians have started targeting the Russian Amazon, if you will. Wildberries is the Russian equivalent of Amazon. But also Wildberries was being used to equip troops on the front lines. Guys were ordering their equipment and supplies through Wildberries. So the Ukrainians started blowing these things up along with the oil refineries, and the Russians still don't have a good answer to the Ukrainian drones. But the fires that these things start when they go up, they look like freaking volcanic eruptions. The smoke plumes coming out of these things, just taking a big chunk out of Russia's GDP, not only hitting their oil refinery capacity, their grain exports in the Black Sea, their oil exports in the Black Sea, now domestic distribution hubs being targeted. Drones are targeting logistics and infrastructure all over the world, guys, not just in Russia and Ukraine. And last one of the day, we got to talk about copper. Copper prices near all-time highs as London is being drained. Now, this is interesting. Metal is leaving London. It's going to the United States and it's going to China. 2 different reasons. But at the end of the day, less copper in the London warehouses means potential for a short squeeze in copper. Stick around to the end of the show for that one, guys. But first, we must shrink my big melon of a head. Let's see what's going on in the world of finance today. Don't forget the like button and the subscribe button for the YouTube algorithm. You can come back tomorrow, have your coffee with the melon heads, because we do this every day. The S&P 500 has just drifted into negative territory, currently down 1 point. You may notice these candles right here that we'll talk in a couple of minutes about some of the silly geopolitical things that happened this morning. But you'll see 6:25 a.m. Eastern time, we had a little bit of a dip up, and then we immediately came right back down. And then about 8:25, we had another big dip. We'll talk about the quotes and the sound bites that drove that. But you can also see that in the Dow chart, currently down 177 points, a third of 1% lower. Again, big dip, came right back down, big dip an hour later. And the NASDAQ is still in positive territory, up by 76 points, or a quarter of 1% ahead of the opening bell. We've got the U.S. dollar is weaker again this morning, 99.42. That is off by 25 basis points. And borrowing costs are higher again, not by that much, but they're going up. The 30-year Treasury, 5.278%. That's higher by a point and change. The 10-year yield is at 4.705, higher by almost 1 basis point, but above 4.7. We've been in the 4.6s for a couple of weeks here. We went as high as 4.72 earlier this morning. It's getting more expensive for Uncle Sam to borrow as he's competing with the AI bros. We've got the 2-year yield is at 4.177. That's higher by half a point. And the 1 month is higher by a half a point at 3.699%. Looking over at Bitcoin, its price is relatively unchanged here, up $500, $63,390 for Bitcoin. Price has been trading sideways for the last couple of months. Looks set to continue. Looking over at the commodities board, we've got metals are a little bit higher this morning. Spot gold, 43.87. That's higher by 11 bucks or a quarter of 1%. We were very briefly over 4,400 for spot gold this morning. Spot silver, 65.30. That's higher by 60 cents or 90.94%. Hit a high this morning of 66.23. Metals continuing to grind higher here. I like this shiny. We've got copper is actually down by a couple of pennies here, although still hovering near all-time highs. Platinum is higher by 0.75%. Palladium is unchanged for the morning. And crude oil is higher by 50 cents or 0.6%. 81.96 for WTI crude. October WTI crude futures. Let's talk about the oil market because we were showing you those big blips in the charts, and it looks like we had another one a couple of minutes ago. Who knows what that one was? But the first one, 6:25-ish a.m. this morning, all right? We got this big drop followed immediately by a big green candle in oil. So what caused that? That was these back-to-back sound bites. First, we got the U.S. and Iran have agreed to extend their 60-day ceasefire. Oh, great. The ceasefire. Just a reminder, guys, we've been under a ceasefire this whole freaking time. That's adorable. And we've decided to extend this pointless ceasefire. And for some reason, oil prices dropped on that news. Okay, and then oil prices immediately came back because minutes later, President Trump goes on Fox News and says, and I quote, the U.S. will bomb the shit out of Oman if they get in the way of negotiations with Iran. Okay, so yeah, we're number one, that's very statesman-like behavior for to say something like that. Number two, okay, bombing somebody else, cool, seems to be the way of things lately. Number three, that was enough to send oil prices pretty much right back up. And, then they started to bounce around, grinded a little bit lower. Then we got about 8:26 a.m. Eastern time. We got another big green candle up. And that was Iran telling us that they're shifting to a fully offensive policy. Oh, I find that offensive. Iran has decided to shift from a defensive posture to a fully offensive strategy, a senior Iranian official told Reuters. Tehran has now given the U.S. a few weeks to fully implement their MOU, warning it will not tolerate an indefinite naval blockade. If diplomacy fails, Iranian entities are prepared to escalate tensions in the Strait of Hormuz and across the region. Yeah, I'd hate for those tensions to escalate. Like, what the hell else are you going to do? Iran says relying on mediators for lasting peace is no longer realistic. All right, so with that, the price of oil started recovering and went pretty much right back up to where it was. And then, look, apparently we had some other stupid soundbite from some other stupid a-hole that's just causing more mayhem a few minutes later. I don't know what that was. That was right as I hit the live button. But suffice it to say, guys, the geopolitics are a freak show this morning. That's putting it mildly. All right, but let's talk about what's going on in the bond market here because the numbers are now just too big, guys. It's the AI bubble. It's stupid that it's gotten to this point. When I first started covering this back in 2023, so sue me, I didn't think they would spend all the money in the world on this. I thought that would have been crazy. And here I am almost 4 years later. Yup, just as crazy. AI is driving up treasury yields. It just touches everything. They have borrowed all the money in the freaking world. An age-old economics tenet posits that excessive government borrowing can leave little room for companies to tap financial markets and drive up their interest rates to punishing levels. It's called the crowding out theory. Now, as the so-called hyperscalers embark on a borrowing binge for artificial intelligence that's hitting the market with a record flood of bonds, hoovering up hundreds of billions of dollars, some are wondering if the opposite is starting to happen. That's not to say that a reverse crowding out effect is forcing the U.S. government to rein in its spending. In fact, it's spending more than ever, running deficits that are unprecedented outside of a crisis. And that, along with the surprising resilience of the economy and the inflationary jolt from the war in Iran, is largely seen as the primary force behind the relentless rise in bond yields that has pushed the Treasury's long-term borrowing costs to a 25-year high and elevated rates across the financial system. The government's borrowing costs are at a 25-year high because everybody's trying to compete to borrow the same dollar And keep in mind how much bigger the government's debt pile is than it was 25 years ago, the last time rates were up here. But as the AI borrowing spree keeps accelerating, blowing past Wall Street's forecast, the spillover effect is, many investors and analysts agree, playing a growing role by taxing the market's ability to absorb so much debt. Whoever's issuing, be it a government or a hyperscaler or a non-hyperscaler credit, is now competing with more borrowers, said Tony Rodriguez, head of fixed income strategy at Nuveen Asset Management, and therefore yields have to be higher. Already this year, investment-grade companies have sold nearly $1.5 trillion of bonds, a 36% jump from a year earlier, putting them on pace to eclipse the record from 2020 when businesses were rushing to seize on non-zero interest rates. Nomura Securities estimates that roughly $200 billion of borrowing by the biggest tech companies alone is equivalent to roughly 25% of the U.S. Treasury's net issuance of notes and bonds to private investors, 5 times more than it was in 2025. There are no signs that the AI debt deluge is slowing. Amazon and Alphabet both recently increased their spending forecasts, with chipmaker Nvidia announcing it's working with Wall Street firms to raise another $500 billion for AI. As the slew of longer-dated bonds keeps hitting the market, some investors have sold U.S. Treasuries. That's freed up cash to buy higher-yielding debt from immensely profitable companies like Alphabet, whose recent 30-year debt was issued at a yield of nearly 6.4%. When these new issues come into the market, there's a premium that comes into play, said Olamide Owolabi, I hope I pronounced that right, a senior portfolio manager for Neuberger Berman, whose $1.1 billion core fund has bought debt sold by Oracle. Meta and Alphabet, among others, are selling treasuries to go buy corporates. That doesn't mean I do not like treasuries. It just means I have a better opportunity. According to Morningstar, bond funds that are limited to investment-grade U.S. debt dialed back their treasury holdings this year and increased their average allocation to corporate bonds to 30%, a 3-year high. A similar shift has been seen among overseas investors, long a key source of funding for the federal government. So you got people who typically buy treasuries are buying fewer treasuries, even though the government's issuing more of them, and they're buying AI debt because they're just issuing so much of it. And that's just the debt that we can see. Oh my God, this thing in the Wall Street Journal today. Why big tech's AI spending is $3 trillion with a T, $3 trillion, pinkies up, Dr. Evil, $3 trillion higher than it seems. Massive spending commitments for data center leases and chips aren't shown on companies' balance sheets. Hey, that's exactly what Enron did, but that's just a trifle detail, right? Let's just do what Enron did and hope for the best, says the CEOs of the biggest companies in the world. And everybody's like, yeah, sure, take my money. Look at this, the top of the pyramid here, which I don't know, why did they decide to do a pyramid chart? I don't know. Take that up with the journal. But the gray area is just the tip of the iceberg, if you will, that the global ship of the economy is currently steaming towards, if you want to use that metaphor. Yeah, the gray is just what we can see. That's your long-term debt, the actual bonds that they've issued, and the lease liabilities that they're currently carrying on their balance sheet. And keep in mind, this is just Alphabet, Amazon, Meta, and Microsoft. This doesn't include Oracle, CoreWeave, Nebius, Iron, Lambda, any of these other companies that are building out data centers. This is just the 4 big ones. $356 billion in long-term debt, $248 billion in lease liabilities. And then there's what lurks beneath the surface. The leases that haven't started yet. $904 billion. The purchase commitments, the chips they have pledged to buy but haven't bought yet. $1.52 trillion with a T. All told, just these 4 companies, more than $3 trillion in spending commitments. And again, I cannot drive this home enough. This doesn't even include Oracle and the Neo clouds and all these shitco Bitcoin miners who are now turning into data center operators. What are we doing? Each quarter, big tech companies disclose their massive capital expenditures on AI infrastructure, from data centers to chips, but those figures don't come close to expressing the full extent of future spending to which Google parent Alphabet, Meta, Oracle, and many others have committed. That's because a huge swath of their coming financial obligations are not reflected on their balance sheets. 9 top tech companies had some $3 trillion of off-balance sheet commitments, mostly related to AI, according to the Wall Street Journal analysis of footnotes in their most recent securities filings. That's just the off-balance sheet commitments, $3 trillion. Those obligations are growing faster than the traditional capex, which totaled about $600 billion over the past year that they reported, and were about triple what the companies owe under their outstanding leases and long-term borrowings. And look at this, guys. The blue line, that is what is off balance sheet, and the gray line is what's on balance sheet. Most of it, they're hiding. And keep in mind, where is this off balance sheet money going to come from? The answer is your retirement. It's so important. That's where they're going to borrow it from, your freaking retirement. And your retirement is already invested in the stocks of these same companies. So if this bet doesn't pay off, both sides of your retirement get killed. America's blue chip tech companies are placing these huge bets based on assumptions about what the demand for AI compute and availability of AI hardware will be in several years. Their hope is that they will easily meet all their obligations with future revenue as consumers and businesses adopt AI in every facet of American life. And understand, if they don't, you are screwed. That's the problem here. If they don't put AI into every facet of American life, profitably so, as these companies have all bet, your retirement pays the price. And then Nvidia very quietly walks back one of these big spending commitments on Friday when they hope you're not paying attention. After the bell on Friday, Nvidia downsizes plans for $250 billion guarantee of OpenAI data center. Nvidia and OpenAI are nearing a deal to finance a large-scale data center campus in Ohio, but have reworked the deal structures so that Nvidia would initially guarantee only half of the planned multi-hundred billion dollar build-out rather than all of it, according to people familiar with the deal. The revised plan would lower the size of Nvidia's financial guarantee from $250 billion to less than $120 billion, a change made to address investors' concerns about the chip maker's risk exposure as it wields its balance sheet to bolster demand for its AI chips. Some of the people said, that is important. Why is Nvidia walking this back? Because the investors are worried that Nvidia is basically buying too much of their own chips. Something, again, if only somebody had been warning us about this for years. A deal could be signed as soon as this weekend. Nvidia's share fell 5% after the Journal first reported the discussions of the $250 billion backstop. That was several weeks ago. Under the outline now being discussed, Nvidia would provide a financial backstop for the first phase, totaling roughly 5 gigawatts of power, and then decide later on whether or not or how to finance the remainder. OpenAI is still in discussions to sign a binding lease for 10 gigawatts of the project in the coming days, according to two people familiar with the project. So Nvidia is backstopping this debt. OpenAI doesn't even have a lease yet. SB Energy, a subsidiary of Japan's SoftBank, is developing the 10 gigawatt site, which would be the largest data center project announced to date. The initial guarantee would come to the data center lease and debt needed to fund the build-out and lower the project's borrowing costs by making lenders feel more confident that the funding behind the project is secure, the Journal reported. Nvidia is discussing a separate deal to finance OpenAI's purchase of chips, which could total $350 billion across the full project. All right, so we went from 250 to 120, and we're like, all right, we're spending less. Oh, no, by the fourth paragraph, here's another $350 billion that we're going to spend. Oh, my God. And again, NVIDIA is going to pay for this. NVIDIA is going to sell chips, and OpenAI is going to pay with NVIDIA's money, and NVIDIA is going to report it as revenue to convince you to buy the stock. The power for the project is controlled by the U.S. government and funded separately by Japan under a recent trade deal. So all the money that you're spending in tariffs is also being funneled into this with the Japanese trade deal and Uncle Sam. Okay, that's just great. Let me send a shout out to Carl Quintanilla at CNBC. All right. And I was shocked to see this from one of the CNBC guys. He says NVIDIA, he's quoting this article here in Business Insider. NVIDIA gets paid upfront. The borrowers and the lenders carry the default risk. And because private credit is ultimately funded by ordinary savers through instruments like pension funds, the tail risk lands on households. And I saw this weekend, and I was in shock that one of the CNBC guys will finally admit this. Carl Quintanilla, thank you. And I posted this earlier this week, and I sincerely hope that everybody else on CNBC will drive home this point, that ultimately the risk of this AI build out lands on households, mom and dad at the dinner table. All right, this is not some hedge fund's money. If they lose it, I don't care. It's just rich people. Guys, this is our money that is being wagered on this. It is my hope that CNBC and Bloomberg and all the other financial press and TV will, with the same frequency and enthusiasm, drive home this point, that it's everyday Americans' money that's being wagered on this, with the same intensity that they have inflated this bubble with all the stupid talking points of people talking about how they're going to build Dyson spheres, invent time travel, cure cancer, and all this other bullshit. Why don't you guys talk about this? Thank you, Carl, for doing this. But why don't you guys talk about this as much as you talk about all the stupid hype on TV? Mention that this is just working families' money is being bet on this. All right. Off that soapbox. Let's talk about China, shall we? China's economic woes mount with disappointing start to the half. China's economy got off to a sluggish start in the second half of the year, reviving pressure on policymakers to support growth after industrial output, consumption, and investment all fared worse than forecast. Guys, remember, as we go through this, Chinese government statistics, grain of salt required. Industrial production expanded 4.5% in July from a year earlier, slowing for the first time in 3 months and missing estimates, according to data released by the National Bureau of Statistics. Retail sales growth slowed to 0.6%, also underperforming expectations. Fixed asset investment fell by more than forecast, 6.7%. That is negative 6.7% for fixed asset investment. That's construction. That's a year-on-year number, and it fell 5.7% in the first half. So it's not only is it shrinking, but it is accelerating to the downside as it goes. The surveyed urban jobless rate climbed to 5.2% from 5.0% in June. The July figures suggest growth in GDP likely decelerated to around 4.1%, below the 4.3% level Beijing needs in the second half to reach its annual growth target, according to Jacqueline Rong, chief China economist at BNP. Declines in overall investment and capital spending on infrastructure accelerated from June by slumping at double-digit rates last month. I read that sentence like 6 times this morning. I still can't figure out what the hell the Wall Street Journal's telling me or Bloomberg's telling me here. Declines in overall investment on capital spending on infrastructure accelerated from June by slumping at double digits rates last month. That's now like the 10th time I've read that sentence. I still can't figure out what the hell they're saying. Nice choice of words there. Who we got here? Bloomberg, whoever it was that wrote that. China's economy is growing slower than expected. And honestly, I question that it's really growing at all, because this is the real problem in China. It's the housing market. China's new home prices fall at faster pace, damping rebound hopes. These rebound hopes I've been hearing so much about for 5 years now? Still not there. China's new home prices fell at a faster pace in July, denting optimism that the prolonged property market downturn may be nearing a bottom. No, it's been nearing a bottom for 5 years. Every article they have to mention the bottom is near every time. For 5 years now, I've been complaining about this. New home prices in 70 cities, excluding state-subsidized housing, dropped 0.18% from June, after the sliding 0.15% in June. Figures from the National Bureau of Statistics showed on Monday. All right, so they fell again in July, and they fell faster than they did in June. Resale home values, which are subject to less government intervention, decreased 0.29%, which is actually a slight improvement from the previous month's 0.32% drop. All right, so new homes falling even faster, existing homes falling, but falling a little bit slower. China's property downturn has weighed on the economy for 5 years, hampering efforts by officials to spur consumer spending and reduce reliance on exports. Other figures released Monday showed retail sales rose less than economists anticipated, while industrial production expanded at a slower rate. China will continue paying the price for the overbuild in homes for years and years, maybe even decades to come. Not sure I would trade places with them, or not sure they'd trade places with us, though, because we have our own comeuppance with this stupid AI bubble, but things on the other side not going so well. And Japan also slowing economic growth. Japan's Q2 growth misses forecast on weaker spending and investment. Japan's economy slowed in the second quarter and missed market forecasts on softer household and business spending, highlighting the fragile nature of its recovery as the Middle East war clouds the outlook. However, long-term bond yields hit a 3-decade high as investors brushed aside the soft reading as reflecting one-off factors and focused more on mounting inflationary risks that could prod the Bank of Japan to raise interest rates next month. Now, that second paragraph is important there. Yeah, bad economic data from Japan, but it's not like bad news is good news here with the Fed. The Bank of Japan is going to hike rates anyway, and so interest rates are rising. Everybody's saying this data is bad, but it wasn't bad enough to convince the central bank to not do what they're about to do. Gross domestic product rose 1.1% in annualized terms. Government data showed on Monday, missing a median market estimate of 2.0% in a Reuters poll. While the data revealed some temporary soft patches in demand, analysts say robust underlying momentum and persistent price pressures are likely to keep the case for imminent interest rate hikes intact. Private consumption was the biggest disappointment in the GDP data, falling by 0.02 versus expectations of a 0.5% increase. All right, so private consumption was supposed to go up. It actually went down a smidge. Analysts said the weakness was due in part to lower school fees households pay thanks to subsidies, which pushed down headline private consumption, but lifted government spending. Okay, that government spending is the problem in Japan, but we'll talk about that later. Capital spending, a key driver of private demand, fell by 1.2% in the second quarter, confounding market forecasts for a 0.4% increase. All right, capital spending was supposed to go up, and it went down. It actually went down by a lot. However, capital expenditure as well as overall preliminary GDP tend to be revised higher with updated figures. Okay, maybe that number gets better. Exports remained resilient thanks to solid U.S. demand for Japanese hybrid vehicles and sustained global investment in artificial intelligence that supported shipments of semiconductor-related equipment and components. So the AI bubble is keeping the Japanese GDP inflated as well. Net external demand, or exports minus imports, added 0.5% to growth, largely because imports fell sharply after the temporary disruption to crude oil shipments through the Strait of Hormuz, which is proving to be not very temporary, by the way. Japanese borrowing costs. Look at them, 2.924 for the Japanese 10-year bond yield. And you'll notice here we have a gap up today. This is the highest we have been in more than 2 decades. It's getting more expensive to borrow in Japan. It's getting more expensive to borrow here. It's getting more expensive for the AI guys to borrow. Everybody's borrowing. The world's running out of money to lend. Sooner or later, they're going to turn the printers back on. It's just a matter of how bad things get before they do. Meanwhile, we've got apocalyptic blaze after massive drone attack hits Moscow region. A massive overnight drone attack in Moscow region set fire to a Wildberries logistics facility with visuals showing the warehouse engulfed in flames. We've had headlines like this for well over a month now. This is the first time we've mentioned it on this channel. Another big one last night. A massive overnight drone attack on Russia's Moscow region set fire to a large warehouse belonging to Wildberries, the country's biggest online retailer. The blaze sent a large plume of smoke into the sky over the Koledino area, with dramatic visuals showing flames spreading across the facility. The attack took place in the early hours of August 16th, with Moscow Regional Governor Andrei Vorobyov describing it as one of the largest drone attacks on the region in recent memory. At least 6 people died across Russia, according to the Associated Press. The Wildberries facility in Koledino, around 45 kilometers south of Moscow, was among the sites affected. Video showed thick smoke rising from the warehouse, while flames could be seen burning across parts of the complex. A second logistics facility in Domodedovo. This other facility in this other place near one of Moscow's major airports was also damaged. In a post on Telegram, Wildberries said a fire broke out at a logistics facility following the attack. It further added that employees had been evacuated beforehand in accordance with safety procedures. Logistics operations have been rerouted. The acceptance of deliveries and the dispatch of orders are being handled at other facilities. Guys, this is billions of dollars in damage. You can see in some of the images here, this was a massive fire. Once these warehouses go up, there's no putting them out. They just got to, you just surround and drown, just let it burn itself out. They're full of boxes. It's full of paper. It's full of oil and other plastic products. There's just no putting these things out. So big chunk of Russia's GDP, man, being taken out by these drones. All right, last one of the day. Copper squeeze. Note the language here, a squeeze. Copper squeeze builds in London as futures advance toward a record. Copper advanced toward a record in London with key spreads flashing warning signs of stiff competition for prompt supplies. The metal spot price traded as much as $543.50 a ton above 3-month contracts on the London Metals Exchange. The biggest gap since a historic squeeze in 2021 prompted the adoption of emergency measures to contain a runaway rally. All right, so what they're saying here, $543 a ton above the 3-month contract for spot metal. So metal right now is way more expensive than metal 3 months from now. That's called backwardation. That means there is a supply shortage in the short term, and the futures market is trying to correct from that. That is a pretty deep backwardation there, $543 a ton. Other spreads have also surged, and futures are closing in on $14,500 plus. That's a peak reached during a spike in January. The current supply crunch is being fueled by a surge of shipments to the U.S. in anticipation of a potential tariff decision, while recent tightness in China has also drawn cargoes there. That has led to stockpiles in the LME's global warehousing network to shrink by almost half since mid-May. LME warehouses are a crucial last resort source of supply to the physical copper industry, and metal in its depots can also be used to close out expiring futures contracts. As the volume of available inventories decline, holders of short futures positions can be forced into bidding wars to compel holders of inventories and expiring long positions to sell. A quirk of the current situation is that total global inventories are not particularly low, just that they are concentrated in the U.S. as traders bet on President Trump slapping tariffs on the refined metal. All right, that's important. There's plenty of metal. It's just in the wrong places. And if President Trump doesn't put the tariffs on refined metal, the price is going to crash. That's what this is telling us. In addition, demand in China is not seen as particularly strong, but smelters there have struggled with feedstock supplies, increasing the need for imports. All right, so what they're talking about in China at the beginning of the year, late last year, the Chinese government cracked down on overcapacity in the Chinese smelters. The Chinese were building copper smelters left and right, and they were operating at a loss. The Chinese government pretty much ordered a crackdown, a reduction on capacity. So now that there is less copper smelting going on in China, there's less refined metal coming to market in China. The market is adapting to that by ordering metal from London. London is also sending metal to the U.S. because people are trying to front-run potential tariffs, whether correct or incorrect. So you got London stuck in the middle, and the metal is flowing outward in both directions. The White House has kept the market guessing on plans for levies of refined copper, with no announcement emerging about 7 weeks after the deadline for the Commerce Department to make a recommendation. Meanwhile, flows to the U.S. have continued as markets price in a potential tariff. So copper hovering around all-time highs. I'm sure the AI bubble is not helping with copper prices either. But I'm not rushing out to invest in copper here, to be honest with you, because number one, tariffs. Good. You want to invest on what President Trump is going to do with tariffs. I wish you luck. Have fun with that. Number two, the China demand thing. I think that's temporary because of the recent perturbation with the smelters. Number three, the AI bubble cannot possibly go on much longer because, as we talked about earlier in the show, they're already borrowing all the freaking money in the world. And a lot of that is being spent on copper. Well, guys, I just want to say thank you very much for having your coffee with us Melonheads this morning. Don't forget all that algorithmic goodness on the way out, the like button and such. Thank you very much to my magnanimous Melonhead supporters, you Patreon, YouTube members, and Buy Me a Coffee members. You guys rock. Links down below should you feel so inclined. I'm on. I did. Love you guys. Everybody, till next time, live small and dream big.